We are in a secular bull trend for precious metals and for commodities. That means that the financial system, and especially the monetary system, is in a secular downtrend. As we know, measured in gold, almost all currencies have gone down by 99% since 1971. We're looking at the risk and the direction, which means that you have to now hold gold and silver to protect yourself from the last catastrophic fall of the currency system in this era. Coming back to forecasting prices, I just know that the currencies will collapse and the gold and silver will continue to reflect that over the next few years, just like they've had throughout history. I showed in a recent video the gold price for a cow. I said before, you shouldn't measure gold in dollars or euros. You should measure it really in chickens or cows. So I produced a chart. What is the price of a cow in gold? And if we look back 5,000 years, you can see in this chart here that the price of a cow has gone between half an ounce and 1 ounce of gold for 5,000 years. I mean, that is quite remarkable. It proves the point that it's totally useless to measure anything in a currency like dollars or yen or euros that is going down by the day. And now, of course, we are in the acceleration phase of the debasement of the currencies. It's not a forecast, but it's an interesting way to look at gold and silver. Now, I said when we started with gold in a major way just under 25 years ago, I said that gold will reach $10,000. That wasn't a forecast or a target. It's just, you know, that when you come to the end of the monetary era, the acceleration will take place of the currency debasement, and therefore gold will reflect that. So 10,000 is just a nice round figure that was likely to be reached. And remember, at the time when we started with gold and silver, gold was around $300 we bought gold at in a major way in 2002. And silver was around $4, I think, at the time. So we now seen a massive growth to $5,000 in the gold price and similar in the silver price. But this is just the start of the acceleration of the precious metals, for the simple reason that, as I said, the way we measure it is going to go down by at least the same amount, if not even faster. Now, so what does that mean in relation to the $10,000 gold price? Well, it means that we are very likely to reach it, and I think probably a lot higher, because final phases of the debasement of currencies, as we saw in the Weimar Republic, for example, is very rapid. Now, 10,000 gold in silver terms, if we take the historical ratio of 15, that is 15 times the silver price is the gold price, or the gold price divided by 15 is the silver price. So 10,000 gold divided by 15, which is the historical ratio, as I said, that means $666 for silver. Now, some people are superstitious and don't like the 666. I'm not superstitious. 666 is just a good number. It probably is a lucky number if you are a silver holder. We will see a lot higher prices in gold and silver measured in today's money. Now, I could easily see the gold-silver ratio not stopping at 15, but going down to 10 or lower, because in these final phases of a move, prices normally accelerate a lot further than the norm, if you want. The norm is the historical norm of 15 of the ratio. We could see still lower gold-silver ratio, and therefore silver price, which accelerates much faster than gold. But remember, it also corrects very fast the other way, which we just saw at the end of January when all the metals corrected. But that was a correction, what we saw at the end of January. We're still in the bull phase. I expect this to last in this cycle. In the short-term or medium-term cycle, I expect that to last another few months, whether that's 4 months or 6 months or whatever, to a lot higher levels. And then we might see at some point a pause for a while until the long-term trend continues for, could be a couple of years, it could be 5 years, it could be 7 years. It doesn't matter. You know that the risk is there, and therefore you have to hold gold and silver in physical form. So there are many factors that will drive this gold and silver price and the debasement of the currencies. Now, obviously, like George Bernard Shaw, we must not trust governments, because the governments are, without fail, always destroy the currency. And we are now, as I said, in the final era of this monetary system, going from $35 an ounce in 1971 to $5,000 today, and to 10,000 and probably a lot higher in the next few years. Now, Shaw said You have to choose between trusting to the natural stability of gold and the natural stability of the honesty and intelligence of the members of the government. And with due respect to these gentlemen, I advise you, as long as the capitalist system lasts, to vote for gold. Really, what Shaw said is that don't trust governments, don't trust what they say, look at what they do. And the consequence of what they do has been throughout history that they destroy the value of the fiat system. And therefore, you have to hold gold and you have to hold silver in physical form and store it outside the banking system in safe jurisdictions. And obviously, you have to have direct access to your metals also. We are, as I have explained many times, we are at the end of not just a monetary era, but with that end of monetary era, it means that inflation will be accelerating and the whole commodity market will reflect that, because we're going to go now from paper assets to real assets. So we will see major falls in stock markets and bond markets and many other bubble asset classes. And commodities in general will reflect the inflation we're going to see. Now, obviously, gold and silver stocks will benefit greatly from this move, and many of them move up a lot faster than the physical metal. But we have to remember that holding the stocks is another level of risk and not pure wealth preservation, because holding the stocks means that you're holding it within the financial system. Banks or asset managers are custodians of this gold and silver, and therefore if something happens to the system, you're not going to be certain if you actually get hold of your gold and silver, and you're not certain what they have done with your shares, if they have pledged them, etc.
For a lot of reasons, when you look at market, first of all, gold cycles tend to be long anyway. Historically, they tend to be long. Since the US came off the gold standard in 71, they've been, 10 years on average. You think of 1970 to 1980, or 1971 to 1980, 2001 to 2011. And so, depending on where you say this bull market started, and it didn't really get going until 2022, 2023. I think we've got a lot more to go. That would be just one sign. Two other signs, if I may, and that's the dynamic of the buyers. I'm not going to say this time is different, but you've got the main buyers now, the central banks, and also Tether, whose influence I think has been underappreciated, underestimated. You've got two major buyers who are price insensitive. I won't say completely agnostic, but certainly price is not the main reason that they decide to buy gold on any given day. And Tether, as you know, bought more gold last year than any central bank. So they're a meaningful player. This is not just something on the margin. And I think for both of those buyers, they have good reasons, which we can get into if you want, but they both have good reasons to continue to be buyers, and they are price agnostic or largely price agnostic. And then, of course, the other thing is, offsetting that is we still don't really have huge retail participation, or generalist participation, I should say. That's a better way of putting it. Generalist, whether they're retail or whether they're small funds or even big funds. We don't have a lot of generalist participation. And so I don't think this bull market is going to end just as 2011 was the top and 1980 was the top. We're not going to get another top until we have very broad retail, very broad generalist participation, as well as, speculative, manic retail participation. And we're not there yet. Look, if you look at central banks, everybody knows that they're diversifying away from the dollar, in the face of, concentration in a single asset. At the beginning of the century, 2001 or 2000, it was like 78% of central bank foreign reserves were in the dollar. So moving away from extreme concentration in a single asset an asset that's owned by a profligate government which is willing to use its dominance and its power to weaponize the dollar. This has been going on for 25 years. I mentioned in 2000 it was 78%. As recently or far away, I should say, as 5 years ago, it had already fallen to 65% of share of central bank foreign reserves in the dollar. So this is